Bloomberg Audio Studios.
Podcasts, radio, news.
Let's bring in Claudia Sahm. She's a New Century Advisors chief economist, former Federal Reserve economist as well, and a good friend of Bloomberg. Claudia, let's think about 2025. I mean, I've got an economy that I think is, kind of puts it along pretty darn well. I got inflation that, well, I'd like it to be a little bit lower. The Fed would like it to be a little bit lower. It's reasonable. The labor market, people who want a job generally have a job. They're getting some wage increases. What are you telling your clients about 2025 in this economy?
Well, don't be complacent. I mean, these, like as you said, if we could keep it as it is right now, largely, this would be another great year ahead of us. We've been surprised at how well the past 2 years have gone, particularly when you think about growth and how the consumers have held up. But that doesn't have to keep going. So what we really want people to focus on are the blind spots, right? What could go wrong? Who isn't getting enough attention? And I think one area, if I had to maybe point some Fed officials to a blind spot, I think, they showed a lot of complacency in their last summary of economic projections on how well the labor market would continue to hold up. What we saw them kind of write down, the typical official, was something that basically has the unemployment rate sticking about where it is right now for the next 3 years. That's a pretty remarkable and frankly would be very unusual path to the labor market. And yet there was all kinds of concerns about inflation and the uncertainty around inflation. But I think I'm still concerned that there are things in the labor market, while good, don't quite look like sustainable. And that's where the problems can come in, and so that's one area that I think is still worth watching.
So if I ask which is a bigger risk, a weakening labor market or a stubborn inflation, you're going with the former rather than the latter.
Inflation's fine right now. I mean, we are really not that far from 2%, and we've seen a lot of encouraging signs under the hood that we are getting to this last mile on inflation.
But right now,
the labor
that's
market
before tariffs. That's before we deport millions of workers. That's before Donald Trump comes into office. So things could change drastically after January 20th.
Absolutely. They could change drastically. And I think it's appropriate that we have had a very deep conversation about the policies that have been put on the table. There have been a lot of policies put on the table, and it's really important to have this conversation and talk about some of their potential pitfalls, and maybe we won't see all of them put into place, and that probably would be a good thing for the economy. And yet, kind of taking for granted the good stuff that we've got going in the economy that's a little more nuts and bolts, like the labor market functioning, and just saying, oh, well, that'll just keep going. That's all fine. It's in a good place. I think that's that could be a real mistake in terms of, because the labor market in particular is always and has been the past few years such a linchpin to this amazing period of a big disinflation, growth has stayed strong, and unemployment has stayed relatively low. And that's something we want to keep going. And I don't think that's to just be taken for granted.
I think I'm very unpopular for asking this question repeatedly. I know.
Okay.
You've got to look at all the risks, right? And if you have to think about potentially inflationary policies and sticky areas of inflation next year, and worries about growth as well, especially if you have kind of a fiscal appetite to pull back, how big of an issue is stagflation, or how big of a worry is it?
There are absolutely paths we could go down where we end up in a stagflationary environment. We're a good ways from that point, because again, we're starting from a well above trend growth, and inflation is relatively low. It's not to 2%, but it's relatively low. But there are absolutely paths we could go on that could get us to stagflation. And the thing about stagflation is, we talk about, think about all the different risks and keep an eye out to the risks, and we do need to do that. But some risks come with bigger problems, right? Solving a stagflationary economic environment, like policy solutions for that, are a lot trickier, because say for the Fed example, they're fighting both inflation and trying to keep employment high, right? And their tools are going to be at odds with each other. So there's some dark corners of the economic world that we want to stay away from, because if we get there, they're a big problem. So I think it's important to think about stagflation. I don't think that's one that's highest probability, but if we get there, is probably one of the highest probability of being a big mess.
How does the consumer look to you, Claudia? Because as you pointed out at the top, the consumer held up much better than we had anticipated in 2024. And yet all the savings, I would guess, are spent off the pandemic era savings. This is a consumer that at least the bottom, 4 quintiles is not well prepared for retirement. The housing market is a tough one to get into if you aren't already, and I guess if you are, that's how you fund your retirement. But what does the consumer look like to you right now in the U.S.?
So as a whole, the consumer is still in a good place. We certainly, as time has gone on, we have seen more strains at lower income households. That's why I keep coming back to the labor market as so essential, because for most Americans, that's where the money comes from that they're going to be spending. So you need a vibrant labor market that has good, strong wage growth, as we have seen, and good job opportunities. So that is so important for the bulk of Americans, the bulk of consumers. We've also seen really positive trends with some probably middle class, upper middle class, wealthier consumers, bolstered by, the stock market has been very good. We've had some trends that have continued to bolster the consumer and their demand. And, I always say, don't bet against the American consumer. Right, like if they have the means to go out and spend, they're going to spend, and that's what we have seen the past few years.
Should I be concerned about this weakness in the manufacturing sector? I know it's only, and I just underline only, 30% of the U.S. economy, but what does that tell you? How do you think about that?
I think we've seen not just one more data point of weakness from the manufacturing sector. We've seen years of what could be seen as contractionary trends in manufacturing. And there, we have to have a discussion that's more about a structural, this is an economy that just hasn't been based on manufacturing to the same way it had been many decades ago. And this is a transition that's been happening very slowly over time. And it's probably one of the discussions that's hardest to have data release, right? Because it just kind of, the trends get glommed together. So, and then, and we're having a very robust, and I think a lot, this year, a big part of this policy discussion is going to be centered around, do you revive the manufacturing sector in the United States, and how do you do it best? We certainly saw under President Biden a lot of tax incentives and big, large programs that were trying to give money to companies to build up manufacturing in different specific sectors. And we may see an approach that's quite different in using tariffs to protect domestic industries, and manufacturing being one area. So I think it's going to be an ongoing discussion, but it really is more about the deep underlying structure of the U.S. economy and what we want that deep underlying structure of the U.S. economy to look like.
Claudia, you look at the long end of the curve and just how much 10-year, 30-year rates have decoupled. How much control does the Federal Reserve really have over that longer end when you see investors equally concerned about other issues like the fiscal term premium needed?
Mm-hmm. So the Fed never has and never will have full control over a 10-year horizon. So the much shorter horizons of treasuries, like the 2-year, you can really have a conversation about. The Fed is very active in what those treasury yields look like. Out at the 10-year, there always are a host of concerns about or issues in the U.S. economy that are going to fit into what do those treasury yields look like. And I think we may... There's just a lot of action right now, right? There's a lot of information coming out of the Fed in terms of where they think they're going to end up in terms of, or potentially end up with the rates. And this whole discussion about the terminal rate or the neutral rate of interest is actually one where, while it comes out of Fed officials' mouths, it is tied very much back to these structural features of the economy. And those are things like productivity or concerns about debt sustainability, demographics, other big issues. And those then can get, those are also issues that the 10-year Treasury plays into. So while, as you said, the Fed doesn't control the 10-year Treasury, and maybe we're seeing that potentially some of those links weaken even more just because the room is getting crowded in terms of issues that people in the Treasury markets need to absorb. But it's nothing unusual per se. It's what's maybe more unusual is there's big question marks out there about the structure of the economy. Like, are we a stronger economy? Are we going to withstand and really thrive with higher interest rates than we did before the pandemic? I mean, and they're very much open questions right now, and very, very central to where those longer dated Treasury markets will land.
I have a curveball question for you, Claudia, as an economist. Were you at the Beta Theta Pi House in March of 1990? No, I'm kidding. What do you think about the effect of GLP-1 drugs on the U.S. economy? We had a listener write in earlier asking why, the government doesn't just subsidize these things and save us billions of dollars a year in terms of health care. What do you think about the effect of this drug? Have you given it any thought?
I think the way an economist like myself would probably tie this back into the economic discussion would be to think about the ability it gives individuals to be more productive as workers, and that fits in the broad category of health and all the different kinds of pharmaceuticals and healthcare that we provide individuals, or they have access to, that can, potentially lengthen lives, make them more rich and fulfilling, make them more able to stay off, say, disability roles and be in the workforce. So I think, a healthier, more productive workforce is one that is going to, benefit the economy as a whole. Do I think, but that's me again, being macroeconomist, very big picture, thinking about the labor market, as I often do, and not, there absolutely will be disruption under the hood in terms of winners and losers in the economy from, particular industries or particular institutions. And there will be, there is an answer to that question in the beginning. The massive budgetary impacts if, say, Medicare or large government programs pick up these kind of drugs, right? So there's all kinds of issues here. But I think in terms of, quality of life, a healthier population, there is a lot of both individual benefits and then there's social benefits from, if a healthier population as a whole.
Claudia, we have to leave it there. Thank you so very much for joining us today. Of course, it's a wild bond market out there, and expectations changing quickly around the course for next year as well. Of course,
and Happy New Year.
And Happy New Year to you. Of course, Happy Holidays.